Okay, here we are, derivatives. And if you think bonds made your head hurt, prepare to have your brain hurt a little bit more. We're going to look at a derivative, and in this case it's going to be a fair value hedge. It's going to be a swap interest rate, and these are the numbers you need to know. Now remember, a swap interest rate literally is the fixed rate, and one party is betting that LIBOR, which is the London rate, is going to be lower than the fixed rate. The other party in the agreement is betting it's going to be higher. So it's sort of a side wager, only it ends up being recorded and kept track of on the balance sheet and the income statement. So hang on to your hats. Let's just kind of figure this out. First thing you need to know is we have a note payable at $5 million. That's its face amount. It has 4 years left on it. It has a fixed rate of 9%, and it's paid at the end of the year. That means you're going to have 9% of $5 million, which I think is $450,000, as a fixed interest payment at the end of the year. We're going to look at what happens to this swap when the interest rate from LIBOR is lower than the fixed rate, and then in the third year when it's higher. Also coming into play is the market rate at 10% in year 4 and the market rate in year 3 that's at 8%. These numbers are all needed to be able to record and maintain the swap. Okay, it's really confusing because there are 3 sets of entries you're going to have to deal with. The first one is going to be the actual interest payment, and that one's going to be a interest expense or a cash, depending on whichever way the market is going, or LIBOR is going. Then you've got to take care of or account for the swap itself, which is a liability or an asset, and the loss and gain of that asset. And you'll also have to, my other entry is missing. Oh, here it is. It's down here. The other one is the fair value of the note itself, the note payable. You're going to have to keep track of it. This actually needs to come up and go here, so it's not quite so confusing for you. So those are your 3 entries you're going to look at as you do this. Get this all nice and neat. So you're going to record the interest payment. You're going to record the amount, or the fair value amount of the swap, and you're going to record the fair value of the note. Now this takes some special accounting, and that's why it's called a fair value accounting. And basically what we're looking at is the difference between the fixed face rate and the market rate is used for the last 2 entries. Only LIBOR is used for the first entry, and I'm quite sure that's really as clear as mud, but let's write this out. LIBOR is used in the first entry. Market is used to calculate the last 2 entries. So it's kind of how it sets out. Let's get that put in there. So it kind of gives you a framework. Now what we end up doing to figure the amounts here and here, which your swap fair value and your note fair value, is use present value tables. So in year 4 we've got a factor for the swap. In year 3 we have a factor for the swap. And then we have factors for the note payable and for year 3 and 4. So those are the numbers we're going to be playing with. I'll send all of this to you guys separately, but this is the core. So let's go look and see what the entries are for this. Let's see if I can really confuse you here. Okay, here's the original entry. They got $5 million in cash and a notes payable. Then at the end of the year, they make a $450 expense and a credit to their cash. Now, normally we're done, right? As long as everything agrees, as long as your market is the same rate as the face, as the blah, 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 in a perfect world. Now, they've entered into this agreement, and like I said, it's a bet. LIBOR was 8.6. That's definitely lower than that 9%. So in this situation, the person who owns the note, who originally went into this with another party, ends up receiving $20,000. And that becomes a credit against the interest expense. So that lowers that interest expense. What this little wager does, or this little swap does, is take a fixed rate note payable and turn it into a variable rate. And as you can see, we're following the LIBOR with this. Okay, but we're not done. Okay, this takes these two entries take care of the swap. But now we have to go down and look and see if the value for that swap changed because of those rates, or because of the market rate. So now we're using market rate. LIBOR is gone, and we're using market rate for the next two. So the swap derivative, when you first got it, had a value of 0 on the book because everything was even. LIBOR was the same as what the face value was. Well, that's now changed. LIBOR is lower. So now we have to adjust the value of the swap derivative as set up. So to find that, you're going to take the market rate, which was at 10, subtract the face amount, which was at 9, multiply that times 5 million, and then bring it to the present value. And the present value is $124,342. So now I'm going to have a debit for the loss of the derivative, the value of the derivative, and a liability now exists. So on the sheet it shows a liability, and that's a credit. Now that's the first part. Second part becomes note payable. What do we typically do when the market, if I were to sell a note at 9%, I wouldn't have a premium or a discount. But if I were to sell that payable and the market rate was different than the face amount, I would have to create some type of contra account to maintain or to recognize the differences between. So in this case, the rate is higher. So that would actually mean my note's not worth as much, in essence. So my note payable now has to be brought back. So that's 10%, 5 million times the factor from the table 3, and taking the interest payment of $450,000, I'm going to multiply that times the factor from table 4 and bring everything back. So that means at this point, if I were to, let's just go back to discounts and premiums. If I were to sell this bond on the market, I could only probably get $4,875,000 for it. So I need to mark it down, in essence, so to speak. So my note payable now has a debit of $124,000, and my debt, gain in value of the debt, is credited. So now, do you notice something interesting about these numbers? They match. I mean, they counter each other. So look what happens when you go to the balance sheet. Now to the income statement. Well, we've got the interest expense, which we had a $20 credit to it because LIBOR was lower. I have a loss in the derivative. I have a gain in the debt. They balance. They counter each other. So in essence, this is zero, the effect. Let's look at the balance sheet. Okay. I now have a notes payable and a liability from the swap. That brings my note payable right up to $5 million. So the two counterbalance each other. Let's go back and go to the next year. Does that kind of make sense? Basically what you've done is you have turned this whole thing into a variable rate. Sometimes it's good and sometimes it's bad, which will, not so bad. But you're going to see in year 3 what happens when LIBOR becomes higher. So I make the payment. We're good at that. There's nothing different about that. But now we do a comparison. LIBOR is at 9.5. That fixed rate is 9. And what happens when it's over the fixed rate? I'm going to pay the other party the difference. So the difference is 0.5%, which means I end up paying them $25,000, but I also end up increasing my interest expense. That's the crux of it. So, if you look at this and you were to end it right now, if you compare 20,000 to 5,000, it probably wasn't the best thing in the world to do with the derivative. But we don't know what's going to happen next year, so we're going to hang on there. Now we have to do the same thing with the swap derivative. Remember, it was a liability last year. But guess what? Now we're on the other side. It's become an asset. So we're going to have to get rid of this liability we had laid out, and we're going to have to add how much it was for an asset. We need our account to reflect that $89,164. So that amount was right here. 9% minus 8% times 5 million times the factor on table 4. So this entry sets up to counterbalance the notes payable here. Now, notes payable, if I compare to the 8% versus the 9% and my present value, again, what am I doing? I'm trying to pull things down here. It's the same thing that you do with a premium. A premium and a discount on the note. I'm not going to pay 9%, or I'm not going to pay 9% for a loan face amount if the market rate is 8%. So in essence, this is kind of like a little premium. So these two figures added together come up to $5,089,164. That 164 right here is kind of acting like a premium on there, isn't it? That's what I would really sell that for in the open market if I wanted to. So that kind of reverses everything you did last year with this one. So now I'm debiting the loss, taking that out. Alright, I'm debiting the loss, and I'm increasing my notes payable. Again, these two, these actually all four of these are counterbalancing when you go to the let me show you. When you go to the balance sheet here. Let's go down and look at the balance sheet at this point. We're now showing that asset for the swap at 89,000, and we're showing the notes payable at its premium on the books. I know that's all clear as mud, and these things are, they hurt when you wrap around them. I guess is the only way I can say this. I did want you to have a view of what a derivative looked like. They take a lot of thinking about and a lot of tearing apart to understand what it's doing. Basically, you're showing you have a derivative, but all of the amounts except for the interest expense that keeps swapping back and forth because of the change in LIBOR are neutralized, as you can see. So that's kind of an overview of a derivative. I hope that's helped somewhat. You can read about it in the book. The book has a fairly good explanation about it. There's also a really good YouTube that kind of explains it. It doesn't go into the entries here, which are really confusing as you go through. But it does cover the interest swap payment. So, well, I hope your head doesn't hurt too hard, and maybe you should probably go take an aspirin. So, thank you. You have a good day.